If you think investing has to be complicated, that is exactly why so many people stay confused for so long. They keep searching for the perfect stock, the secret strategy, the one move that will make them rich faster than everyone else. And in that search, they usually lose the one thing that matters most, which is time. I have watched people spend years chasing clever answers to a simple problem. Most of them did not need more information. They needed fewer distractions and a better way to think. When people ask me what index funds they really need, what they usually mean is this: how do I grow my money without spending my life worrying about it? That is the real question. Not how do I beat every investor on the planet this year? Not how do I look smart at a dinner table? Not how do I turn a small amount of money into a fortune by next summer? The real question is, how do I build something dependable, understandable, and durable? That is the question that deserves an honest answer. I have always believed that investing works best when it is simple enough to keep doing in good times and bad. A plan is only useful if you can stick with it when headlines get ugly, when markets fall hard, and when your emotions start making promises your judgment should never accept. That is where most people fail. They do not fail because they are unintelligent. They fail because they build a system that depends on perfect behavior. And perfect behavior is rare. The average person does not need a collection of 20 funds, 10 market opinions, and a new prediction every week. The average person needs exposure to productive businesses, broad diversification, low costs, and enough peace of mind to stay invested. That is it. But human nature resists simple answers because simple answers do not feel exciting. People often assume that if something is easy to understand, it must not be powerful. Yet in investing, the opposite is often true. A good investment plan should feel almost boring. That may not be what people want to hear, but boring is often where the money is made. Excitement invites activity, and too much activity usually invites mistakes. The more buttons a person feels tempted to press, the more likely he is to interrupt the compounding that could have made him wealthy. I have seen people ruin sound plans by trying to improve them every few months. They were not defeated by the market. They were defeated by their own impatience. That is why index funds deserve serious respect. They do not promise brilliance. They do not flatter the ego. They simply allow you to own a wide group of businesses, keep costs low, and let the economy do what it has done for a very long time, which is reward productivity over time. An index fund is not magic. It is discipline with a structure around it. It protects people from some of the worst instincts they have when money is involved. Now, when I say the only index funds you really need, I am not saying every person on earth should own the exact same thing in the exact same proportion forever. Life is not that tidy. A 25-year-old building wealth has a different emotional tolerance from a retiree who needs stability and income. But the principle stays the same. Most people only need a strong foundation, not a warehouse full of financial products. They need a plan they can understand in one quiet sitting, not one that requires constant supervision. The hidden problem in investing is not lack of opportunity. It is overreaction. People see too many choices and start believing more choices must mean better outcomes. In reality, more choices often create more confusion. And confusion leads to hesitation, bad timing, and emotional decisions. A person buys when the market feels safe, then sells when it feels dangerous, which usually means buying high and selling low in a more polite costume. That behavior has cost ordinary families more wealth than any recession ever could. I want you to think about the way most people handle money. They work hard for it. They protect it carefully in daily life. They compare prices at the store. They hesitate before making a large purchase. But when it comes to investing, they suddenly become vulnerable to stories, forecasts, and noise. They become less patient with the most important money they have. That contradiction is one of the great ironies of personal finance. Rational people can become deeply irrational the moment markets begin moving quickly. So let me put this plainly. If you are an ordinary investor who wants to build wealth sensibly, the core of your portfolio usually does not need to be complicated. A broad U.S. stock market index fund or a broad S&P 500 index fund often gives you ownership in a large collection of leading American businesses. That means you are not betting your future on one chief executive, one product cycle, or one piece of news. You are aligning yourself with the long-term earning power of a wide field of enterprises. And for many people, that alone handles the growth side of the equation remarkably well. But life is not only about growth, life is also about temperament. It is about whether you can sleep at night. It is about whether you can keep your plan intact during a storm. That is where a broad bond index fund can have a role. Not because bonds are exciting, not because they make headlines, but because stability has value. A calmer portfolio can keep a person from making a panic decision that destroys years of patient progress. That is an important truth people often ignore. The best portfolio is not the one that looks the smartest on paper. It is the one you can hold through fear, boredom, envy, and uncertainty. A simpler mix of one broad stock index fund and, when needed, one broad bond index fund has helped many people do exactly that. It is not flashy. It is not a story you brag about, but it gives you something more useful than excitement. It gives you durability. I have always thought that good investing should fit real life. Real life includes children, bills, career changes, illness, surprises, and long stretches where you do not want to think about finance every day. That is why simple index investing makes so much sense for so many people. It respects the fact that your life has priorities beyond market commentary. It allows your money to work without demanding your constant attention. In a world full of noise, that is a powerful advantage. Imagine two people. The first one spends years hopping from fund to fund, trying to predict sectors, watching interviews, reacting to every market swing, and feeling clever right before feeling anxious. The second one buys a few broad, low-cost index funds, contributes steadily, ignores the circus, and keeps living his life. The first person may look more sophisticated. The second person often ends up wealthier, not because he knows more, but because he interrupts himself less. That is what many people misunderstand about successful investing. Intelligence matters, but behavior matters more than most people think. You do not need to be the fastest thinker in the room. You need to be the steadiest. You need a system that does not tempt you into self-sabotage. Index funds, used wisely, can provide that system. They remove the pressure to always be right. They replace prediction with participation. And for most people, participation in a productive economy is more than enough. When I look at what truly builds wealth over time, I keep coming back to a few quiet ideas. Own good businesses through a broad index. Keep your costs low. Reinvest. Stay patient. Do not let fear or excitement rewrite your plan. Those ideas are not dramatic, but they are powerful. Wealth is often built by respecting ordinary principles for an extraordinary length of time. So when someone asks me which index funds they really need, my answer begins with simplicity. You usually need a broad stock index fund as your engine for long-term growth. You may also need a broad bond index fund to match your age, your goals, and your ability to stay calm when markets get rough. Beyond that, every additional layer should have a clear purpose, not just a persuasive sales pitch. Complexity should earn its place. Most of the time, it does not. The real gift of the right index funds is not just diversification. It is clarity. Clarity helps you stay invested. Clarity helps you ignore noise. Clarity helps you keep your emotions from taking the wheel. And once you understand that, you stop asking how many funds make you look sophisticated. You start asking which simple structure gives you the highest chance of staying consistent for decades. That is a much better question. and better questions usually lead to better results. If you keep that principle in mind, you begin to see why so many investors get lost. They are not building portfolios. They are collecting ideas. 1 month it is technology. Next month it is dividends, then international funds, then small caps, then something a friend mentioned after reading one article over breakfast. Piece by piece, the portfolio becomes a reflection of mood, not judgment. And when a portfolio is built on mood, it rarely survives pressure. I have never believed that owning more things automatically makes a person safer. In many cases, it simply makes him less clear about what he owns and why he owns it. Real diversification is not about creating a crowded list. It is about reducing unnecessary dependence on any single outcome. A broad index fund already gives you that in a meaningful way. It spreads your future across many businesses, many industries, and many sources of earnings power. That is a very different thing from owning a pile of overlapping funds. You barely understand. A lot of people confuse movement with progress. They rebalance too often, change direction too quickly, and treat every market decline like a personal emergency. But markets have always tested people. That is not new. The names change, the headlines change, the fears get dressed in new language, but the emotional pattern is old. People feel confident near the top, doubtful near the bottom, and impatient almost everywhere in between. A sound index strategy works because it does not ask you to predict human emotion. It asks you to prepare for it. That is why the right fund is only part of the answer. The other part is the right mindset. You can buy an excellent index fund and still get poor results if you treat it like a lottery ticket or abandon it at the first sign of discomfort. What matters is not just what you own, but how you behave while you own it. A disciplined investor with a simple portfolio usually does better than an emotional investor with a brilliant one. The market rewards patience more consistently than it rewards excitement. I want you to think of investing the way you might think of planting a tree. If you dig it up every few weeks to check the roots, you do not help it grow. You weaken it. Money works much the same way. Compounding needs time, but it also needs stability. It needs a person who can leave a good process alone long enough for the results to become visible. That is one of the reasons index funds are so powerful. They make it easier to stop digging up the tree. Now, some people will still ask whether they need international exposure, whether they need a total world fund, or whether they should keep everything centered in the United States. Those are fair questions. But even there, the answer should remain grounded in simplicity. If a person wants a single broad solution, a total world stock index fund can serve that purpose well. If he believes strongly in the long-term strength of American business, a broad U.S. stock index can also make sense as the main engine. The key is not finding the perfect debate answer. The key is choosing a sensible path and staying with it. That is something many people resist because they want certainty before commitment. They want proof that one choice will outperform every alternative before they begin. But life does not offer that kind of guarantee. Investing is not about certainty. It is about intelligent probability. You choose what is broad, low cost, durable, and understandable. Then you give that choice time to work. The need for perfect certainty has delayed more good decisions than bad information ever has. I have often found that people want a financial plan that removes all discomfort. That plan does not exist. Even the best index fund will go through declines. Even a balanced portfolio will have periods that feel disappointing. Even the right approach will sometimes look wrong for a while. That is the admission price. You do not get long-term returns without short-term uncertainty. Anyone who tells you otherwise is selling comfort, not truth. And comfort, when sold that way, is usually expensive. So the question becomes simpler than people expect. Can you accept temporary discomfort in exchange for long-term strength? Can you own a broad slice of business without demanding constant reassurance? Can you let time do the heavy lifting instead of trying to replace it with motion. If you can, then you do not need a complicated portfolio. You need a rational one. And rational portfolios are usually much smaller than emotional ones. For a young investor, that may mean leaning heavily on one broad stock index fund and adding steadily month after month for someone closer to retirement. It may mean pairing that same stock exposure with a broad bond index fund to reduce the emotional and financial shock of sharp downturns. Different stages of life justify different balances, but they do not require a different philosophy. The philosophy remains simple. Own productive assets, keep expenses low, match risk to temperament. Stay the course. I want to say something here that may matter more than any fund selection. The purpose of investing is not to create constant entertainment. It is to serve your life. The money is supposed to support your freedom, your family, your peace of mind, and your ability to make choices with less fear. If your investment approach makes you more anxious, more reactive, and more distracted from the people and work that matter, something has gone wrong. A good portfolio should bring order to your financial life, not more chaos. That is why I admire simplicity. Simplicity leaves room for discipline. It leaves less space for vanity. It lowers the odds that you will outsmart yourself. And most of all, it helps you remember that wealth is usually built not by doing extraordinary things, but by doing ordinary things for an extraordinarily long time. A broad index fund may look humble, but humility has built more lasting fortunes than ego ever will. So when I say the only index funds you really need, I mean that most people can reach their goals with a very small number of sensible tools. One broad stock index fund can do a tremendous amount of heavy lifting. One broad bond index fund can provide balance when balance is needed. In some cases, one total world stock index fund may serve as an all-in-one global foundation. But the deeper lesson is that the number matters less than the clarity. You do not need many moving parts. You need a plan you will still respect when the mood of the market changes. If you remember nothing else, remember this. The greatest enemy of good investing is not lack of access. It is unnecessary complexity mixed with unstable behavior. The more confused you are, the more emotional you become. The more emotional you become, the more likely you are to abandon what would have worked. That is why simplicity is not laziness in investing. Simplicity is discipline in a cleaner form. I have spent a lifetime watching how money behaves, but even more importantly, how people behave around money. And I can tell you this with great confidence. Most people do not need a more impressive portfolio. They need a more durable temperament. They need fewer decisions, fewer temptations, fewer reasons to panic, and fewer chances to interfere with their own future. That is exactly what the right index funds can offer when they are paired with patience. In the end, wealth is rarely a reward for intensity alone. It is more often a reward for consistency. The people who win are not always the ones who started with the most. Very often, they are the ones who found a sensible process and kept going while others kept changing. They allowed time to become their partner. They understood that quiet discipline can outperform dramatic intelligence when given enough years. So if you are still asking which index funds you really need, let me leave you with a calm answer. You need the ones that give you broad ownership, low cost, and the emotional strength to stay invested. You need the ones simple enough to understand and strong enough to endure. You need the ones that help you act like an owner, not a gambler. And once you have that, your next job is not to search endlessly for more. Your next job is to remain steady long enough for wisdom to turn into results